Could the advanced child tax credit, that's right, the child tax credit that normally shows up in your tax return that's now being paid out on a monthly basis, could that actually cause you to pay a tax penalty? Yes, 2 different ways. I've got them coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Corhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. If you're a fan of the Wise Money Show, and I hope you are, you're not surprised to hear me say I'm not a fan of the advanced child tax credit. I am not. And if you say this guy's mean or I disagree, check out my other videos on the topic, because it's just to me an unnecessary disaster. An unnecessary waste, cost, frustration, and potential, has the potential to create all sorts of tax problems for individuals. Now, yes, can it help some? And turning this into a monthly income amount, could that help some folks? I think it could. I think it could. Now, I would argue they're going to get the help in a few months when they file their taxes. So getting it on a monthly basis instead is, 6 in one, half dozen the other. I mean, it's almost the same thing, but it's just while there's that chance that it could help some, I think it creates huge headaches and problems for others. One such problem could be a tax penalty. That's right. That's right. Now, is everyone going to face a tax penalty? No, but could you? Yes. This advanced child tax credit could actually create a tax penalty for you in a couple different ways. Now, first, let's just talk about a tax penalty. Why could you get a tax penalty? Well, the type of penalty I'm talking about is an underpayment penalty. I'm not talking about failure to file or fraud or whatever else. I'm talking about an underpayment penalty, and that is if you owe taxes. So when you file your tax return, if you haven't paid in enough and you actually owe the IRS, sometimes you could owe a penalty. Sometimes you could even owe penalty and interest if it's not paid on time. So underpayment penalty, why does that happen? Well, if your income for married filing jointly is adjusted gross income below $150,000, then in order to avoid the tax penalty, you need to have paid in through withholdings or through tax estimates or credits. Now that's the key point here. You have to have paid in at least 90% of your tax, okay? And if you don't know what your tax is, well, then you need to have paid in at least 100% of what your tax was last year, because you've at least filed last year's taxes, right? And that's going to help you determine, well, how much should you pay in for this year? So if your income is below $150,000 adjusted gross income if you're married filing jointly, or $75,000 if you're single filing, then in order to avoid an underpayment penalty, you've got to pay at least 90% of what your tax actually is, or pay 100% of what your tax was last year. Not what you withheld last year, what your actual tax was. If your income is above that $75,000 individual or single filer, or $150,000 married filing jointly, then it's still that 90% of this year, but it's 110% of your tax bill last year. So essentially, those are the rules. Work with your CFP on that. Make sure they're doing comprehensive financial planning and tax planning. Those are the rules, and essentially it's sort of, unless your income is going straight up forever and ever and ever, they want you to just get to the point where you're not owing when you file your taxes every single year, that you're getting close to break even, or that you're getting a tax refund. I told you there's 3 ways to get taxes paid in, okay? Your tax calculation is going to be what it is. And you need to be doing tax planning to make sure that you're capturing all ways to improve and reduce your tax bill, okay, over your lifetime. You don't want to just pay the least amount of tax every single year. You want to pay the least amount of tax over your lifetime, okay? And so that's squeezing down the amount of tax that's created. But the way to pay in taxes is to do tax withholdings, quarterly tax estimates that aren't actually every quarter, or tax credits. So here's where this advanced child tax credit could create a tax penalty. Well, in the past, In the past, you've had these child tax credits that show up on your tax return, and they count along with your withholdings and along with your any tax estimates that you'd pay to make sure, well, here's how much you had paid in, here's how much you owed, you're good. Here's how much your tax bill was, here's how much you paid in, you're good or you're not. That goes to count towards that 90% of this year's tax or 100% of last year's tax or 110% of last year's tax. Your credits go towards that calculation. Well, if you're receiving some of these tax credits in advance, if you're receiving them on a monthly basis instead of on your tax return, you will have less paid in. And when you look at when the IRS does their tax calculation, when you do your taxes and you look at here's what your tax was and then here's how much was paid in, if you have less credits because you received them in advance, now you might be below that 90% threshold. If you were used to owing a little bit, if you owed a little bit last year, but in your credits, your child tax credits helped you get to the point, but you still owed a little bit, now your tax credits will be less on your tax return because you're receiving them in advance. Now you could have less than 90% paid in, bam, penalty. Or if you're above that, if you're trying to do the safe harbor with 100% of last year or 110% of last year, that 110% or 100% of last year, if now you don't have credits applying towards that, bam, you could be exposed to an underpayment penalty. The second is, what if you receive the wrong amount? What if you receive some advanced child tax credit and you're not supposed to? What if you're ineligible, your income makes you ineligible, you need to add back some of those credits that you already received. Now all of a sudden your tax has gone up and your withholdings or your payments have gone down, and expanding that threshold again where you don't have 90% paid in or 100% of last year or 110% of last year. Those gaps right there, because of the changes, you're getting this credit in advance instead of it showing up on your tax return, that for some could cause a tax penalty. What's the point? The point is your tax situation has changed. If you've got kids, the way that they structure the tax credit, it has changed. You haven't done anything. They've changed the system. You need to then be proactive with your tax situation. Something has changed in your tax situation. All right, how do I project that it's going to influence me and what adjustments should I make? You need proactive tax planning, sitting down with your certified financial planner who understands your tax picture and understands the tax code and can tell you, projecting out, all right, here's what your taxes look like, therefore these are the adjustments you need to make. You need to opt out of the advanced child tax credit, you need to increase your withholdings, you need to begin paying estimates, you need to shift from Roth to pre-tax, you need to add contributions, take your advanced child tax credit, fund it directly into your HSA, something like that. Those are the creative ideas, the proactive planning work and the creative strategies that you need a CFP in your life to provide. So if your CFP is doing that, wonderful, you're on the right track. If you don't have a CFP doing that proactive tax planning, you can always call one on my team. Find us online, corehorn.com. That's Corehorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.